This problem asks us to analyze a quote about the Australian dollar falling in value after inflation was less than expected, which caused the central bank to be less likely to raise interest rates. All right, so the first part of this question is trying to understand why a lower inflation rate than expected would make the central bank less likely to raise interest rates. Right, so why would a central bank raise interest rates? So why raise R? We'll call that the interest rate. So why would you raise it? You'd want to raise it to curb borrowing, right? Because when R is higher, the interest rate is higher. That means you have to pay back loans that you would take out on higher interest, right? And you're also, so you're going to curb borrowing and you want to encourage saving, which will fund more investment. Right, so when you raise the interest rate, you're going to get a better return on your saving, and then there'll be more funds available to be borrowed and loaned out for investment. Right, so you would want to raise the interest rate if you want to slow down the economy right now, right? You want less people borrowing and spending money right now, and you want to encourage them to save that money for slow growth later with investment. Right, so if the inflation rate is lower than expected, that means inflation is less of a concern than we thought, right? So economy isn't as hot as we thought, right? So the economy isn't running away from us if we think, if we find out that inflation is lower than expected. So we don't really need to curb borrowing or encourage saving. Maybe the growth is where we want it to be. All right, so now that we know that a lower inflation rate than expected will lead us to maybe not raise interest rates, now we want to think about why not raising interest rates would cause the value of the domestic dollar to fall. Right, so if you don't raise interest rates, that means less people want to invest domestically, right? Because they're getting a lower return on their investment, on their saving, right? If interest rates are low, then when you save or invest, you're not going to get as big of a return, right? So if less people want to invest domestically, more people want to invest in foreign places, right? Foreign. So if more people want to invest in foreign nations, excuse me, that means that you want to bring your money somewhere else. So you're using the domestic Australian dollar to buy other dollars, right? So you're a lot of more people are going to demand foreign money using Australian money, right? Because you have to exchange it to invest there, and so that means the value of the Australian dollar is going to depreciate, right? So domestic dollar depreciates against foreign currency. And why is this? That's because more demand for foreign money using domestic dollar, right? So our domestic dollar is going to be worth less because the demand for the foreign dollar is going to go up, and so we're going to have to use more domestic dollars in order to get this foreign money, which is in higher demand, which will raise the price of it in Australian dollars.